More on exchange rates. We defined what exchange rates were. Now we ask, why did they change? We have at least two important theories, and I'm not going to lie, they're unrelated. But both important, and sometimes either can explain why exchange rates move. So this gets complicated pretty quick. One of the theories is purchasing power parity, PPP. It has its own abbreviation. Clearly it's important. This is the idea that tradable goods tend to cost about the same in different countries. Otherwise, people can make a profit by importing or exporting them. If you have family in another country, you've probably dealt with requests to bring back things like electronics or fashion items when you visit, or vice versa when you come back to New York. You've done this arbitrage. Now, there are complicated ways that big companies want to make it difficult to do that. They know people would do it even more. They had to fight to keep profits. But there remain plenty of things that people can and do make a profit by importing or exporting, if there's a difference in price. In the long run, we expect that exchange rates are going to move so that tradable goods cost a similar amount of money in each country. I say similar because not everything's easy to trade. Bricks, for instance. You're not going to put a ton of bricks on a plane just to make a penny a brick more. Some things are relatively easier to move around. Like medicine. That's why manufacturers try to make it difficult with regulation and safety rules. Services are difficult to trade without a transformation of business processes. The Economist magazine creates a Big Mac index, which just looks at a simple question: how much does a Big Mac cost in cities around the world? Now, Big Mac is not directly tradable. It's going to get cold by the time you get off the plane. Nobody can want that. But the stuff that goes into it is tradable. Beef, wheat, ketchup, whatever. So generally, if a good has a price that's high in country A and low in country B, then people are going to buy low and sell high. That'll tend to increase the demand in country B, which will raise the price there. That will increase the supply in country A and lower the price there. The price gap will narrow. The purchasing power parity theory says that exchange rates should tend towards levels that make tradable goods have similar prices around the world. Another theory of why foreign exchange rates will change is interest rate parity. This depends more on hot money than on trade. Investors can buy bonds from domestic or various foreign governments, and those pay different interest rates. With forward transactions, investors can lock in their return on foreign investments. We'd expect those returns should be equivalent. For example, if E is currently 120 the foreign currency per dollar, and the dollar interest rate is 2.5%, while the foreign interest rate is 2%, investors face a choice. Stay in dollars, buy the dollar bond at the end of the year, get 102.5. Or take that same $100, convert foreign exchange, get 12,000 of those foreign currency units, invest those at 2%, that gives 12,240 at the end of the year. Convert those back into dollars, that's 12,240 divided by E. But E at the end of the year, that's a different value. What future value of E makes those two choices the same? Because if they don't have the same value, investors will choose the one that makes more money, and that's going to move prices. Obviously, there are fees involved, but for now, we'll ignore those, because for large institutional investors, those are going to be pretty small. Let's draw a picture to help. We start with $100 and take either of two paths. The green line at top stays in dollars. The bottom path, the bottom, goes through foreign currency. If you keep the investment in dollars, then after a year, $100 becomes 100 times 1 plus R dollars. I notate it as RD, since that's the domestic interest rate. Or think of it as the dollar interest rate. It's RD either way. On the other hand, if you follow the blue line through foreign currency, the $100 becomes 100 times E units of foreign currency. And I'm going to be specific. We know that E changes over time, currency values change, so I'll denote E0 as the exchange rate now times 0. After a year, the exchange rate will be E1. That's later. For now, the $100 will change into 100 times E0 units of foreign currency. That gets an interest rate of RF, the foreign interest rate available. After a year, it's worth 100 times E0 times 1 plus RF in units of foreign currency. How many dollars is that? Well, divide by E1, the exchange rate at the end of the year. And then those should be equal. 100 times 1 plus RD should equal 100 times 1 plus RF times E0 over E1. If they're not equal, somebody could make money by moving it around. And remember, we said the FX markets move something like $5 trillion each day. So there's plenty of money moving around all the time. And, can agree on an exchange rate a year ahead. Anybody can lock in profit if any of those rates are wrong. Now, I'm not saying it's simple. There are a lot of currencies, many different government bonds, different maturities, but profits to be made by finding any places where that equation doesn't hold. And as people take those profits, prices are going to move to make that equation hold. So this should stay. Now, we derived it with $100 as for instance, but you can see that if you divide both sides by 100, that drops out. The equation says 1 plus RD should equal 1 plus RF times the ratio E0 to E1. To review, we carefully distinguish between E0, the exchange rate now, and E1, the exchange rate in the future. Also differentiate between RD, the domestic interest rate, and RF, the foreign interest rate. If investors can lock in a future interest rate, we call that covered interest rate parity. They're covering the exchange. That's cheap for major currencies. Could be expensive or maybe not even available for smaller currencies that are thinly traded. If the future exchange rate is not locked in, then it's uncovered interest rate parity. And I'm not getting into risk for now. Sometimes the government will not make the payment, but the basic idea is there. From this equation that 1 plus RD should equal 1 plus RF times the ratio of E0 over E1, what has to happen to make that hold? Well, if the foreign interest rate is higher than the domestic interest rate, RF greater than RD, then that means the ratio of E0 to E1 must be less than 1, which means that E1 must be higher than E0, which means the dollar must appreciate. Or the same as saying the foreign currency depreciates. If investors can get a higher interest rate when paid in a different currency, then that different currency must be becoming less valuable. Same argument in the opposite direction. If the foreign interest rate were lower than domestic interest rate, that means the ratio of exchange rates would be greater than 1, and the foreign currency would be expected to appreciate instead. Investors get a lower interest rate paid in something that's getting more valuable. We go through this argument carefully in order to understand the limits. It all depends on availability of a lot of financial instruments and cheap transactions. Some countries make it difficult to trade their currency, which allows them to keep an interest rate that's not linked to the wider world. The biggest country doing that currently is China. It's difficult to convert their currency into other currencies. That means they can keep their interest rates different from the rest of the world. They can set their own monetary policy. And that brings it back. Everything is linked together. So a country's monetary policy depends on restrictions on trading their currency. It's complicated.